Now an AFR special, banking on your future.
And we continue our series now on banking on your future. Today we take a look at debt and how to get rid of it. There's good debt and bad debt, obviously, and a key to this is your money and how you take advantage of it to get rid of the bad debt. And here to talk about this discussion is Drew Miller, again, from Beneficial Savings Bank. And, well, Mr. Miller, here we are again. We're talking about debt, and it seems that everybody's got debt. There's, gosh, household expenses, living expenses, there's personal spending, credit card debt. Take your pick. How do we deal with this?
Well, I think we have to be very disciplined, and we should only take on debt when we know we have to be able to do it and we know we can afford it.
Well, people don't typically take that sound reasoning with them when they're in the department store and they've got a credit card in their pocket. Do we know how much the American public tends to be overloaded with debt? I guess it's hard to get real numbers on this, but any percentages at all?
Well, there's all types of different numbers that have been out, but in the last couple of years, you know, the Federal Reserve and a couple other agencies were saying that the American consumer had the highest percentage of their total income in debt.
Yeah. What about credit cards? You know, there are some people who walk around with, 3, 4, 5 credit cards and even more in their wallets and in their purses. Wouldn't you say that that's probably one of the #1 traps?
Yes, credit cards has taken away the thought process. You know, back in the 50s, maybe even the 60s, if someone wanted to buy a refrigerator or a range, they had to think about it. They had to apply for an installment loan, things of that nature. Credit cards are very good. It's convenient, but also it's real easy to use if you're not disciplined with it.
And we hear so much about 0% interest or no money down or no payments until the next year or the next 2 years, and that's very alluring to a person who's eager to spend. But we should second guess some of this, shouldn't we?
Always read the fine print and make sure you know exactly what you're getting into, because if it just says no payments for 12 months, well, just remember when that 12-month period up, those payments start to kick in. You better make sure you're able to afford it.
And isn't there also, there's some that the interest won't accrue, for say that 12 months, but if you haven't paid this off, by the time that they say in the contract, then all of it is backloaded to that point?
You would have to read it because there's a lot of different plans out there, but the key is going to be you may hear 0% for 12 months, but then you also want to hear what the rest of it is, where it could be 16, 17, or 18%.
Because the initial lure is that, oh my goodness, it's like free money for 12 months. I'm going to take this deal, but you don't know that coming around the corner is where they really get you.
As long as you know you can pay it off in that 12-month period, it's a great deal.
We've talked a lot about mortgages, and that's one of those debts. Obviously people have to have a mortgage. They have to have somewhere to live. But the way that they're managing these mortgages have gotten a lot of people in trouble.
There's a lot of different mortgages out there. I mean, years ago, you just had a 30-year fixed rate mortgage. That was the standard. And then you came up with some adjustable rate mortgages. But in the last 4 to 5 years, you have the interest-only mortgage. You have the option mortgages where you could pay interest only for 1 month, or only a nominal payment where you may have negative amortization. So there's a lot of more creative mortgages out there, but a lot of people don't know the consequences of everything.
And wouldn't you say that people are always trying to get, I think it's just human nature, you're always trying to get the biggest bang for the smallest amount of buck, but the buck may come in later, as we keep saying, but it's the lure of not having to pay it right away. Would you say that some of the early traps that people fall into, or is one how they underestimate where the money's really going to come from, and 2, they don't have a solid plan on how they're going to pay for it?
I think that's part of it also, and I think part of it is, buying a home is a very exciting thing. But they don't realize all the other costs that come along with it. Gas, electric, water, homeowners insurance, etc. So those numbers really add up, and you really should look at all those other expenses.
Okay, look at all the other expenses. Any final parting words of something that might help someone who's thinking, I'm just in so much debt, I don't know what to do?
Best thing to do is probably just, contact your local banker or a financial planner or something of that nature. They'll be able to sit down and at least give you some options.
Yeah, read the fine print and be careful out
Always.
there. Huh? Yeah, credit cards can be a dangerous thing. It's a lot of fun. But you've got to pay the piper sooner or later.
Absolutely.
Drew Miller, thank you very much
Art.
for sharing some sage advice with us, and let's hope that it's going to help somebody out there who's trying to reduce their debt load.
Okay.
Okay, we'll see you later. All right, and make sure you join us as we continue our discussion in our series, Banking on Your Future, and we'll examine new ways that you can revamp your retirement plan.